Hello, everyone, and thanks for tuning in. Today, I want to give you a clear, straight up view of where I think the New Zealand economy and property market are sitting right now. Whether you're already investing, you're looking to get started, or just trying to figure out what's going on, there's a lot of noise out there, and not all of it helps. The truth is, we're in a changing market. Things aren't falling apart, but they're not racing ahead either. It's a reset of types, and parts of it are actually improving. House prices, for example, have stabilised. They're now ticking back up. Most of the major banks, Westpac, ANZ, BNZ, they're forecasting modest growth for house prices this year, 4 to 6% in 25, most of it sort of towards the end of the year. Now, that's solid growth, nothing crazy, but it's a clear sign that we've likely found a floor in the housing market. Now, here's something I can't stress enough. You need to stay invested. Whether it's real estate, shares, gold, even Bitcoin, long term wealth is built by being in the market, in appreciating assets, not sitting on the sidelines. Cash is not the safe option that it used to be. With inflation running at around 6 or 7%, and no, I don't believe the 2% CPI figure that gets thrown around. I mean, just look at the real costs: medical care, education, rates. They're all increasing well beyond 2% per annum. I mean, here's a local example. Hamilton City Council rates. Their increases for the next 3 years, 16.5%, 15.5%, and then 14.6 in year 3. That's nearly 50% increase in council taxes over 3 years. And then 2% inflation. Yeah, right. Holding cash is guaranteeing yourself a loss in real terms. You're going backwards. I mean, it's smart to have some liquidity, but sitting on too much cash, thinking you're being safe, you're not. You're quietly bleeding value every single day. Right, let's get into some of the details. The economy is out of recession, but fragile. I mean, New Zealand's technically out of recession. The GDP grows 0.7% in the fourth quarter of 24. That beat expectations after a tough 23. That's good news, but it's patchy. We've seen some strength in retail, real estate, exporting, and tourism, but consumer confidence is very low, and government spending is under a lot of pressure after years of borrowing. So, they're having to cut back. The Reserve Bank has cut the OCR by 1.75% since August 24, so that's down to 3.75. But more cuts are expected. Many expect it to fall low as 3% OCR, and I think it's needed. I mean, economists believe the neutral rate for the New Zealand OCR is 3%. We're currently at 3.75. So that means that the OCR is still a handbrake on the economy. I think they're taking too long to cut rates, and, why draw out the pain? Just cut it and let's get things moving again. The property market's showing signs of life. After a downturn in 23, the market's starting to find its feet again. February 25 data from CoreLogic shows house prices rose 0.3%. It's not very much, but it's the biggest monthly increase in over a year. So it's showing a shift in sentiment, I think. Why? What are the drivers? Lower interest rates, more confident buyers, and I think a growing sense that the worst is behind us. And as I mentioned before, those forecasts coming in sort of 4 to 6% growth this year. So investors are starting to step back in, especially where yields are improving. So, there's some improvement there. Housing affordability. Now, that's something that I haven't seen splashed across the headlines, but housing affordability has actually improved quite a lot. In 2021, the house price to income ratio peaked at around 10 to 1, right? Today it's down to 6.7. That's a major improvement. Why has that happened? Well, house prices are down about 14% since the peak in 21. Incomes have risen, and mortgage rates have eased back. So that's all helped. It's still tough in places like Auckland and Queenstown, but overall, we're in a slightly more affordable place than we were a couple of years ago. Rents are still climbing. Buying might be more achievable, but renting is actually getting harder. National rent to income ratio is at 28%. That's a new high, up from the long-term average of 26%. The Bay of Plenty is now the most expensive region to rent, $680 a week. That's more than Auckland and Wellington. Why? Well, because we've throttled the supply, really. I mean, well, not in Auckland. Auckland's still got an overhang of townhouses, a lot of accidental landlords, but in other places around the country, we've pushed landlords out of the market. They removed interest deductibility. I know it's slowly coming back. They've made a lot of tenancy law changes, increased compliance costs. So I think there are fewer rentals. Fewer rentals mean higher rents. And again, outside of that hangover of large blocks of townhouses built in Auckland, I think those rents are going to keep going up. We're going to, there's going to be a story of rental shortages again. Now let's talk about inflation. Inflation is here to stay, right? Money printing is here to stay. Governments around the world, ours included, will continue spending more than they collect in taxes. Whether it's another pandemic, a war, or some new crisis, the playbook's always the same. They print more money. Inflation is built into the system. Politicians want to stay in power, so handing out cash, that keeps people happy, at least short term. People have been saying houses are unaffordable for decades. They said it when houses cost 10 grand. They said it when houses cost 100 grand. Now they're $1 million, but they're going to keep going up, right? Because of inflation, because the money supply keeps on growing. And so do wages, right? As inflation goes up and the cost of goods, and then people get paid more and so on. So, and at the bottom line, tough as it might be, if average Kiwi can't afford a home, someone else will buy it, right? Institutions, big companies, wealthy investors. In the US, BlackRock is already buying up entire suburbs and renting them out. So that trend could come here too. I mean, I hope it doesn't, but it could. Right, development. What's going on in property development? What am I seeing at the moment? From a property development perspective, I'm active, but I'm cautious. Hamilton and Cambridge are now facing major issues with water and wastewater capacity, and that alone is limiting the number of viable development sites. So spending a lot of time doing due diligence and finding out, we can't develop those sites. Consenting has become a lot more difficult, especially on that water and wastewater side, having to pay consultants to do modelling to tell the councils whether their pipes will handle a new development. I'm also having to deal with driveway naming now in Waipa District. So the council's calling the driveway a road, so it needs a road name. The process probably takes 7 or 8 months to get through the whole process to get a road name. But it's really, really important because it's part of the 223, 224 requirement. So if I haven't done it in time, I won't get my title. No title means no finance. So talking about all the business, you've also got to think about taking care of yourself, right? So I know I talk a lot about business and money and wealth and growing and all the rest of it, but you've got to keep fit. Get outside, go for a walk, try park run. It's free. Saturday morning, go for a walk, go for a run. I've been playing a lot of golf lately. Fresh air, a challenge. Going out with a few mates, and I'm really enjoying it. And I feel better. So success is a long game. So you need to be fit enough to enjoy it. All right. Coming back to property, sort of. We're getting towards the end here. Where's property heading? It's hard to say exactly. Now, one thing I do know is that property moves in cycles. We're coming out of a slump, and just like every other cycle, there'll come a time again when people are fighting over property at auctions and paying whatever it takes to get it. So, that's just going to come again. The thing that actually worries me most about New Zealand at the moment are our falling living standards. Our kids are falling behind in their education. Internationally, teenagers are up to 2 years behind in maths on international comparisons. That's got long-term consequences. So you need to invest in yourself, learn everything you can, read, take courses, grow your skills. Warren Buffett said the best investment you can make is in yourself, and I really believe that. That's the most important thing you can do is just learn everything you can, experience things. So what should you be doing right now? Stay invested, focus on fundamentals, look for opportunities, diversify your assets, and think long term. The best investors aren't lucky. They're the ones who stay in the game, even when it's tough. And it is tough. Right now, property investing's tough, property development's tough, but you've got to stick with it. The market is stabilizing, the economy is coming out of a recession, affordability is improving, rents are up. The opportunities are out there, but only if you're ready to act. So buy well, hold long, and remember that getting rich slowly still beats going broke fast. Let me say that again. Getting rich slowly still beats going broke fast. So thanks for listening. If you're getting into property development or you want to get better at property development, do my property mastery course. You'll find it over at thepropertydevelopmentclub.com. That's thepropertydevelopmentclub.com. I'm John Kenel. You can follow me on LinkedIn, Facebook, and Instagram. Until next time, thanks very much for listening. Cheers.